We've got three fantastic speakers here who hopefully will bring sustainable investment to life and you know, help you to see why I love the area so much and always have. Talking on three amazing subjects, and then the person who's speaking after is Mark Campanale, who I don't think Mark's here yet, but Mark was basically one of the two people who got me into this area back in '91 when I kind of went, wow, that's amazing. That's what I want to do. So you've got a really good final quarter of the day. Not that the other three quarters haven't been. I think they've, I like to think, I'm digging myself a hole here. Anyway, I think it's all worked, but you're in for a treat here. We've got three different sessions, and we have got Schroders, M&G, and at Liontrust presenting on three very different subjects, which is fantastic. So, Stephanie, could I perhaps ask you to kick off, please, and actually start by introducing yourself, and then kick off with talking about the critical role of nature in investment decisions.
Brilliant, thank you. Is this working? Yes.
It is now. Yeah.
Perfect, thanks. Thank you so much for having me to speak today. My name is Stephanie Williams, and I am a sustainable investment analyst at Schroders, with a particular focus on natural capital and biodiversity. So I think we're all well aware that climate has become a real talking point and focus area within the investment industry, but the probably slightly underappreciated risk that we should also be paying much attention to is nature. Now, it's often said that these are twin crises, as climate change is one of the main drivers of nature loss, but also if nature declines, then that exacerbates climate change in and of itself. 50% of GDP is said to be dependent on nature, and yet we have systematically degraded our natural capital over decades. This is partly because ecosystem services that we depend upon have not been rightly priced. The WWF estimates that the ecosystem services that we depend upon give us value of around $125 trillion per year, and yet we only really pay for those ecosystem services at 1/40th of that price. So that's why we're seeing biodiversity loss at the fastest time in history at this point in time. We're overusing our natural capital 1.7 times over in comparison to the kind of biocapacity to regenerate that in nature and ecosystem services. But what does that actually mean in an investment context? It's kind of hard to conceptualize, but various studies have been done at economy levels to try and articulate those risks. So the World Bank has found that if even a partial collapse of ecosystem services were to occur, we would be seeing a 2.3% decline in GDP annually. Similarly, the UK government has just done a big study on our own economy and found that we could lose up to 6% of GDP in the 2030s if we don't take into account nature degradation and nature loss. So some fairly staggering statistics as a result. But how does this then translate through to something actionable for investors? I think it's often difficult to conceptualize where are the areas to gain exposure to the nature-related opportunities potentially associated with some of these risks, but also to mitigate the potential downsides. So we know that there's about a $711 billion funding gap when it comes to biodiversity, but there are three broad areas that we like to think of as the potential investment areas. So these we would lay out as solution providers, so the kinds of companies that are creating goods and services that are acting to halt or reverse nature loss, and I'll go into a bit more detail on what those sort of mean. Second area would be investing in nature-based solutions and real assets, so agriculture and timberland, which is more on the private asset side and a much more direct investment in nature as that asset class. And then the third is investing in transition companies. Now, this is potentially the hardest because that's sort of the companies which are most exposed to nature-related risks, but also those that are managing them in the most proactive way. So with the solution providers front, this is probably the most familiar to most people because it's that sort of thematic exposure through funds such as circular economy funds or sustainable food and water funds, which we run. And it looks at trying to capture the exposure to things like pollution prevention, or alternative packaging solutions, and so on. So this is sort of where, when you talk about nature in the investment space, most people have moved to instinctively. But on the second area of nature-based solutions and real assets, this is probably a little bit more of a nascent area, but one that is gaining appetite and interest from the investment industry, because the kinds of returns that you can gain from these kinds of asset classes both capture the returns from the sort of harvested resources from the timberland or the agriculture, real assets, and also now increasingly the environmental assets which those asset classes are providing in the form of carbon or indeed potentially biodiversity through the use of credits, for instance. And that final area of transition companies is probably, as I said, the hardest to articulate, because one of the biggest concerns levied in the nature-related space is that we don't have the data to quantify what does good look like when it comes to companies managing nature risks. This is because on the climate front, we've always had carbon emissions as that central focus point, whereas there isn't an equivalent of a singular metric when it comes to nature. And that probably speaks to the complexity of the topic. But we have got some data from companies over many years, just not in a consolidated way, but we're seeing increasing disclosures and frameworks to try and consolidate nature-related information in the corporate space at least. And so what we've been working on at Schroders is creating a proprietary model to understand the exposure of companies to those nature-related risks, but also how well they're managing them, so that we can use those two axes to go on to define what does a transition company look like, and then create potential universes around them, or also to try and target engagement. So under those sort of three umbrellas of solution providers, nature-based solutions and real assets, and then transition companies, we can start to gain and understand our exposure to nature. I think that's dead on 6 minutes. So
You've got 1 second.
hopefully.
That's stunning timing. Thank you, that's brilliant. So nature, and now we've got a focus from Ben on impact accounting as a tool to transform finance. That's a fairly big topic. Ben, go ahead, please.
Yeah. I thought I'd wake everyone up and get everyone really excited by talking about accounting at the end of the day. But I'm going to sort of touch on two things, one of which absolutely follows on from the previous topic of nature and biodiversity, and then one is, which is a massive challenge I think we all have to tackle, and investors are increasingly focused on it. But the second part is this aspect of impact accounting, which we think is a solution to that problem, a solution to kind of fixing the plumbing, if you like, that needs fixing urgently and I think systemically if we're going to tackle these big sustainability issues and we're going to transform finance and the economy in the way that I think many of us think is absolutely necessary. So the first topic linking to the planetary challenges that we've just been talking about is something that the Stockholm Resilience Centre has just updated, and this is really a pitch or a flag or a plug for something that I think is, potentially transformational in terms of availability of information, providing information on the challenges that our planet faces in a really engaging, really digestible, free and open to access way. And so that concept is the concept of the planetary boundaries, which many of you will have heard about. Really, it's the 9 Earth systems that collectively reflect the entire Earth system and are required to be functioning for us to live productive, sustainable, happy lives. And so these 9 planetary boundaries, the latest update from the Stockholm Resilience Centre is that we're pushing through overshooting the safe operating space on 6 of those 9 planetary boundaries. The boundaries, by the way, cover everything from the climate to land use and how we're degrading biodiversity and natural capital through changes in land use. It covers things like excessive use of materials, agricultural chemicals for agriculture. It covers the excessive pollution of chemicals and plastics in our environment. So really it's taking these various different Earth systems and saying we're overshooting on 6 out of 9 of them. And this new website, this new update called the Planetary Health Check, which the website is called planetaryhealthcheck.org, is, I think, an amazing resource for all of us to look at, use, both identify what the scale of the challenge is and how we're progressing in the wrong way, and or when we start improving things, hopefully. But it's also a really useful source and platform for highlighting what the solutions to those challenges are. And you touched on some of those solutions already. So now, that's the scale of the problem, and I just think this planetary health check, produced by the Stockholm Resilience Centre, is incredibly useful, and I think will start guiding businesses, investors, governments to recognise the scale of the challenge and to work out how we need to move forward. Moving on to the accounting piece, which I think is, as I said, a pretty prosaic, boring topic to touch on, but I think impact accounting or impact-weighted accounting could be something that really drives the change in how financiers, how businesses, and how governments think about what's a real-world picture of the good or the bad that individual companies are generating. So what impact accounting does very quickly, in a minute and a half, is really to take a company's revenues or profits and to consider whether those are being generated in a way and from a business and via products and services that are contributing positively to society and the planet, or whether they are actually damaging or acting negatively on people, the planet, and society. So, for example, you would take 2 companies. One might be a business that is treating its employees incredibly well, paying them above living wage, looking after the health and safety of those employees, supporting projects in their local community, reducing its carbon emissions, making sure it's not polluting into local rivers or the local environment, and producing a product that is actually helpful for the world. Could be, renewable energy generation, could be a waste management system, could be a sort of really important health product. Now that is one company A. Take company B, and company B is a business that is not treating its employees well. The business is paying below living wage. It's got lots of sort of issues in the local community which it isn't actively supporting. It is polluting into the environment, doesn't care about cutting its carbon emissions, and is producing a product or a service that is maybe contributing to planetary or human health challenges. Now, at the moment, those 2 companies, their $10 million of profits, hypothetically, will be treated in accounting terms in exactly the same way. What impact accounting does is it says, let's break down the sources of that profit, of those revenues, and then apply a sort of positive element or a negative element to those. So, for example, it will weight up or weight down those accounts based on whether that company is contributing to society or not. And very briefly, the value in that, I think, is enormous, and I think it could be a transformational change in how investors and businesses and governments think about how we treat companies. And if we need to move towards a positive impact economy, which I think we all agree we do, this is a tool, a rather prosaic, potentially slightly boring one, but a transformational tool to get us to think properly about whether companies are adding or subtracting from society. So with that, I've gone 20 seconds or so over, but not too bad. But and by the way, that's open source, free to use, really interesting initiative. Happy to talk about it afterwards, but I think it's something we'll be hearing more and more about in the future, hopefully.
That's really interesting perspective, and hopefully we get some questions on that in a minute. I'm going to hand over to Mike next, please, on the pace of change, which actually hopefully will feed into the final speaker's session today as well, because we've got this theme that things are changing, right? So the pace of change and its influence on sustainability engagement and the size of the investable universe, no less.
Great, I'm Mike Appleby. I work at Liontrust on the Sustainable Future team. I've done it for 20 years. I don't look old enough, you all cry, but yes, it's true. So I'm going to try and talk about this using no jargon whatsoever, because I think this is the key. So I want to talk about change, and everyone's got a different view on the pace of change. So when I'm talking about change, I'm talking about improving the degree to which we're impacting on the environment or society when we're doing business and we're investing in those businesses. So if you imagine I'm a climate change scientist, I know all about the details. We've got to halve emissions in the next decade. I also have read the Stern report. I realise it's going to cost us more to do nothing than it is to cost us to do something. My view of what I want to invest in and the world and how quickly I want it to change will be very different than someone else who I'm going to politely refer to as the, what did I call it? The pragmatic incrementalist, who is someone who essentially understands that we need change, but they don't want to rock the boat too much. Let's do it maybe 1% a year, something like that. We'll get there in 20 years' time, it'll be 20% lower or whatever. And these are two extremes, but it explains a lot of the differences in what people think of as a sustainable company. So, for example, a big oil company. You know, one of those people, it's actually quite sensible to invest in them. They're a good British company. They're investing in renewables, but not too quickly. And, you know, that's great. Someone else is going to be appalled by the fact that you're making profits out of a, you know, climate wrecker, etc. And unfortunately, if you put these two people in a room, they're very unlikely to change one another's mind. They might do, but their views are quite intransient. And I'm just trying to say there's a spectrum in between that, and everyone's somewhere on that spectrum of how quickly they want the world to change. And that explains a lot about why something might be sustainable for one person, but not for someone else, because their view of the pace of change is very, very different. And that affects what you're able to invest in as well. I would love to invest in a company that's carbon negative, so it's taking carbon out of the environment. It's nature positive. It's somehow making the environment better than it was when it started. Everyone's really happy, really well paid, really well diverse, and it's a profitable company. Well, there are hardly any of those around. In fact, I can't think of one, let alone getting a nice portfolio. It might come in time. And then similarly, it's not all about climate change. Someone might be very concerned about human rights, and they would expect much higher of a company that they're invested in than the incremental pragmatalist, who might be happy with policies. Whereas the other person might be, look, I want to know, have they signed up to the, you know, the Sustainable Cotton Initiative? Are they part of the Foreigner Safety Accord that came out of the terrible collapse in Bangladesh? Have they done an audit on their supply chain? How many suppliers are they not using anymore, or what are they doing? So these are all very valid views, but I'm just trying to get, it all comes back to how quickly you think things need to change. But critically, it's not just about your value. It also potentially has a massive influence on what the companies in your portfolio are going to be worth, depending on the pace of change. And I think this is often forgotten within this, in that if you are invested in a company that is the wrong side of, let's say, the energy transition, and that they have to basically turn their industry round, and the costs, the externalities of that business have yet to be brought back on that business, that is a big risk. Similarly, if you're invested in companies that are benefiting from and contributing to positive change, they potentially will do much, much better than those other companies, but it depends on the pace of change. And I think, certainly from where I sit, the market generally is a bit of a pragmatic incrementalist. There are very few people that would argue that the current system is perfect. There are some, but they'll keep it quiet because they're probably doing very well. Thank you very much. But most people accept that there's going to be a change. But I would just reiterate that it's not just about values in terms of your personal values, but it's also about what the company is going to be worth in the future. And I think that's often forgotten in some of these conversations. Oh, I've got 1 more minute. What was I going to say? But change is happening, but it's not happening fast enough collectively. But there are some pockets where there's some incredible change going on. And, you know, we're seeing, you know, the UK's decarbonised its electricity grid by 50% since I've been doing this in 20 years, whatever. That's incredible. It could go faster, and I expect that will accelerate. But that overall pace of change, I think, is still something which is too slow. Where am I? I've got 30 seconds or something.
Please, that's fine. Yep.
So I'd reiterate a number of things that have been said today. Try and use plain English. The trouble with jargon is it means different things to different people. Try and just say in a sentence what it's about. And I think that understanding someone, what their pace of change can really help you understand the kind of investment and also the kind of conversation that the investment manager is going to be having on your behalf. How demanding are you being? Are you the pragmatic incrementalist and going, look, if you disclose and you go down 1% a year, that's totally fine? Or are you saying, we know it's a challenge, but we want you to halve your absolute emissions over the next decade? That helps explain, that pace of change helps explain the investable universe, the quality of the conversation and how demanding investment managers are going to be, and also ultimately will be reflected, we believe, in the value of your pension at the end of it all. And I'm going to stop there.
Brilliant, thank you. Did we all feel like we just learnt something in this panel? Yeah? Brilliant, thank you so much. So I just had to ask that question because I felt like I did. So we have got a couple of minutes for questions, and I would say to you, if you're here, obviously Mark Campanelli is a brilliant speaker too, so you know, please just mine this information from these brilliant people who know what they're talking about, because you're going to find it useful. Mark, over here, if I could have a mic, please.
Just wanted to ask Ben about his view on the work that's going on IAS 37, given that you brought up accounting, which is trying to flip the incentives around sustainability in a fashion of making net zero commitments an obligation and therefore a liability on the balance sheet. The good news about that is that anything that you do to reduce that liability, to invest towards net zero, becomes an asset. Have you given much thought to that, and how you see that in the context of the remarks that you made on impact accounting?
Great question. As a non-accountant, I will herald or I'll precurse my comments with that fact. You probably know a lot more about that particular piece of regulation or push than I do. But I think in principle, you know, the point on the plumbing and accounting being a really critical aspect of plumbing in the current economic system, let alone in terms of one of the tools that financial analysts and fund managers use to evaluate the strength or weaknesses or the issues in the companies we invest in. I think it's an incredibly powerful and probably undersung hero of the energy transition and of a more sustainable future. So my view, as someone who is involved in running a sustainable and impact fund, is that kind of mechanism is great. I would love to see more companies really pushed with, certainly encouraged by carrots, but I think we're at a stage where we need to see companies and businesses and directors and boards pushed with a stick. And I think that's actually quite an effective stick. But you're right. The interesting point about what you said is that there is an incentive in there. There's a positive carrot incentive in there. So to me, that seems like a smart tool, a smart mechanism. You know, I think the implementation of these sort of suggestions and ideas are often challenged and pushed back, particularly because they don't apply probably equally to all types of company, all sizes of company, all stages of company development. But I think in essence, that's very aligned with what I was talking about, the impact accounting, which is about adjusting up and down a company's accounts for whether they're doing good or bad, simply. And that's a good one. I mean, our climate team back at M&G are looking at that as a mechanism. The other similar one is that, you know, there's a push to get, and I think, I can't remember, Mark Campanale might have a view on this as well, or might be involved in this, but there's a push to get company transition plans built into a company's accounts as a, you know, as an asset or a liability, which I think is very much sort of aligned with what you're saying. I think I think we should use all the tools that we've got in the toolkit, frankly, and that to me is an effective one. I'll see what anyone else says, but I'd love to also know whether you think it's good.
I think we'll have to take that up over a drink, over a glass of wine. Yeah, thank you. So I'm going to cut off to try and keep us more or less. Well, we will finish by 5:30. Just saying, but we're a few minutes over on this now. Any other really burning questions? Alexander, just really super brief in the interest of the agenda, if that's okay.
When we know from the science that we're not doing enough collectively, and I'm not supposed to have consumer detriment, at what stage do they wake up to blame me for consumer detriment?
What time do they wake up with what? Sorry, what was the last?
Me for consumer detriment because a client lost out because they didn't invest in the right ESG and impact funds.
I think, I mean, we see prices going up, don't we? So I think we're getting that in some areas now, aren't we? We see homes being flooded. We see consumer detriment. Let's pick that one. Well, unless anyone's got any immediate answers for that, let's pick that one up over a glass of wine, shall we? Because I think we're starting to see it, right? But we're not recognising it as such, is my personal opinion, that things are happening to the detriment of real people. And it's not necessarily being priced in properly, insurance companies exiting Florida, etc. But anyway, right, let's move on swiftly. If I can say just one more time, if you can thank this panel for a really brilliant session. Thank you.